Great. And if you can.
Yeah, just go, oops. Hang on.
Okay.
Are you trying to go to slideshow?
Yeah, I'm just, yeah, it's
yeah, there's a slideshow. Yeah, there you go.
Sorry, I've got things popping up and I'm trying to
do 85 things at once.
Mm-hmm. Exactly.
Okay. Well, okay, we'll get started because I know even though people are still coming in, I know we're all busy. So good afternoon and welcome, and thank you all for joining us on this lunchtime presentation. My name is Bridgette White with Hickok and Boardman Capital Management, and I co-chair the Women United Council along with Rachel Goyette. And on behalf of our entire council, we are very, very excited to have you all, and we want to extend a very, very warm welcome. We know this pandemic has impacted us all in so many different ways, and I believe financial uncertainty has probably never been greater. And so we're really excited to be able to host the call today, or this webinar today. We've got over 110 people registered, so people will be kind of joining us. And in addition, many of you have opted to donate, and together we've raised over $600. So all of these proceeds will be used to purchase gift cards for underserved women and families in our Tri-County area. And thank you so much for your generosity. And Carrie, maybe you can post a link if folks are interested in making a donation somewhere in the chat box. So if you've never been to a United Way, or I'm sorry, a Women United event, let me tell you a little bit about us. We are a group of diverse, caring, we're diverse and we're caring and we're women that want to create change. That's what we do. And collectively, we direct our effort and energy towards helping women achieve financial stability. We do this through the support and expertise of the United Way of Northwest Vermont. So we organize, we educate, we raise funds, and we volunteer. And so again, we're all really, really excited that you can join us today. So before I introduce our speaker, I want to take care of a few housekeeping items. Carrie has made sure that we're all muted. If you're not muted, if you've unmuted so you can chit chat, if you can please mute yourselves to make sure that that reduces all feedback. Also, if you're new to Zoom and you just want to see and hear the speaker, if you, in your little thumbnail sketch, there should be kind of a square, the second thing in will show just the active speaker. And I should warn you all that this presentation is being recorded. So today's format will be approximately 30 to 35 minutes of presentation, followed by 10 to 15 minutes of question and answer. So we ask that you use the chat button for your questions, and we may stop and pause and field some of those questions along the way, but I'll be doing my best to sort of organize and gather the questions, and Zuzana can address them later in the presentation. So now it's time to hand it over to our presenter, and I'm very, very excited to introduce Zuzana Brochu, who is a certified financial planner and the Vice President of Financial Planning Strategy with People's United. Zuzana heads the organization's financial planning department, which helps clients develop a comprehensive view of their situation, identify their financial goals, and create a roadmap to achieve these goals. Zuzana joined People's United in 2002 and has extensive experience in financial planning. Prior to joining People's United, Zuzana worked for Bank Boston. She earned her BS in Business Administration from Appalachian State University, and she has an MBA from the University of Vermont. In addition to being a certified financial planner, she is also a certified business exit consultant. She's very active in the community, a 2015 graduate of the Leadership Champlain program, and is also on the board of the Vermont Council of World Affairs. So, Zuzana.
Thank you so much for that introduction. It's lovely to be with everybody and see so many faces on Zoom. So good afternoon. And I'd like to begin with a story. earlier this year, I was supposed to travel back to Europe for my high school reunion. And of course, my trip got canceled because of the pandemic. So needless to say, I was disappointed, and I decided to just take the week off anyway and stay local. And since I couldn't travel, I thought I would play this little game and pretend that I was actually overseas. And something really magical started to happen. I would go for a bike ride or a hike, or maybe I would go watch the sunset over Lake Champlain. And a view that I might have seen 100 times before somehow became breathtaking again. And I realized that I was looking at familiar sights through fresh eyes. And that's when it dawned on me that there might be a different way to look at this current situation. Now, I certainly do not mean to diminish what we're all going through. This has been an exceedingly difficult time for so many of us in so many different ways. People have lost their loved ones, people have lost their jobs, we have lost our opportunity to see our friends and family. So there's a lot going on there. And yet, I do feel that there is a way for us to see opportunity, even in our most dire situation. And what I want to talk to you about today is how we can all look at our current financial situation, which frankly may not seem very bright right now, but see an opportunity in there. And by that, I mean an opportunity to take control, to start feeling empowered again. We can take an opportunity to put our financial house in order. So before I jump into this, and Carrie, if you could actually advance the slides for me. Are you able to do that? There you go. So you can jump to the next one. So I'd like to set the stage. And in my mind, we have been experiencing a confluence of these three factors, each of them very significant. First, the pandemic, and of course, the associated recession and the impact on our jobs, all the job losses out there. Then there's the stock market volatility. And also from a financial planning standpoint, the new legislation. Back in December, the Secure Act was introduced. And then earlier this year, the CARES Act. Now, in my mind, as a financial planner, each of these three things by itself would be reason enough to revisit our financial plan. But all three at once, to me, that's some sort of a perfect storm of financial planning. And with that, I'd like to talk a little bit about how to look at this. So you can, if you could advance again to the next slide, Carrie, please. You can think of your financial plan as sort of a diagram of your financial situation, and it may be a roadmap into your future. And as things change in our lives, so should that plan be changing accordingly, right? Maybe imagine you're driving along and you're using Google Maps. And Google Maps is getting you from point A to point B. But now, suppose that on your way, you run into an unexpected accident. That's where we are right now. There's a lot of things that are going on that are unexpected, that are not what we had originally planned for. And so we need to readjust that Google Maps. And that's what I want to talk to you about today. So I would like to walk you through 5 strategies that for me stand out as areas that we should be focusing on from a financial standpoint right now. And I took the liberty as I go through these slides to actually use some of the photos from my staycation that I talked about earlier. And I'm doing that as kind of a reminder to all of us that there is a different way to look at this situation. And it's not easy, but I do hope that to the extent we can all remain hopeful and we can see the opportunity in what's going on. So first slide, cash flows. Clearly, that's the big one. Cash flows look very different for most of us. Some have lost their jobs. Some have been furloughed. Some have had their hours cut back. I have a lot of clients who are in the pre-retirement years and they're asking, am I still on track? So this is exactly the time that we as financial planners talk about when we say people should have 3 to 6 months of living expenses available in an emergency fund. So to the extent that you have that, this is an okay time to be tapping into that money. But it's also really important to be revisiting our budget. And a big mistake that I see people make is that they start taking out loans before they revisit their budget, especially 401k loans. And I realize that this is not a popular thing to say. And I know that there are special provisions in the CARES Act to be able to take 401k loans with better terms than you might otherwise. But let's remember, 401k loans need to be repaid with after-tax money. And so they are not an efficient way to borrow. And then another, what I might call a financial planning transgression that I see is people dipping into their retirement accounts. And I get it, especially if you've been laid off, tapping into that former employer's 401k is very tempting. And it seems like a good idea because it will kind of hold you over. However, you are not only, and I know that there have been some changes relative to not having to pay the tax penalties on dipping into retirement accounts, again, through the CARES Act. But you still have to pay the taxes, and you also are sort of living at the expense of your financial future at this point, namely your retirement. So it really is very important to be revisiting our budget right now and taking a look at what's discretionary and what's truly necessary. So I guess 2020, among other things, is a year for us to be looking at needs versus wants. And, you know, actually here, I feel compelled to share a little story. So when my younger daughter was about 5 years old, I was trying to teach her the difference between things that we need and things that we want. And one day we went to the store and she was interested in some toy or another. And I thought, well, this would be a great opportunity for a little financial literacy lecture for my 5-year-old. So I talked to her about needs and wants. And when I got done, she looks me straight in the eye and she goes, and Mommy, that fancy orange jacket you got last week, is that something you needed or is that something you wanted? So I was completely busted on that one. Anyway, so I do realize that talking about needs versus wants is not a way to make a lot of friends, but it is the conversation for 2020, unfortunately. And the good news here is that there are things we are probably saving money on right now because of COVID. Some of us are working from home, so we are saving money on gas for commuting. There are probably things we're not doing, like we're not eating out as much. We might not be doing a lot of traveling because of the travel restrictions and cutting back on vacations, cutting back on things like movies and entertainment. So it's a really good opportunity to take stock, and I would really encourage all of us to take a close look at what are these things that we are able to save money on right now, and let's redeploy them to where they're needed most, where that money's needed most right now. And for example, this might be health insurance. If you lost your job and you lost your employer's health insurance along with it, this might be an opportunity to be redeploying some of those things to a place where it's really needed most. Another place, I just talked about dipping into our savings, right? Our kind of rainy day fund. Well, that rainy day fund will likely run out at some point. And so being able to think about replenishing that and making sure that there's enough there, that's another good opportunity for some of those COVID savings to go. But okay, so let's be realistic here and let's step back. Yes, we're going to start looking at needs versus wants. Yes, we're going to redeploy some of our savings, but we've done all of this and now we still have a cash flow issue. So what do we next? What do we do next? Where should we turn next? And let me talk about a few options here that are on the table that I think we might want to be exploring. For those of you who have some investments outside of a retirement account, something like a taxable brokerage account, that might be a good place to go next. Now, you will obviously have to pay capital gains taxes on anything, any realized gains if you sell those securities. But there might be another option here too. You may be able to get a line of credit that's available secured by that investment account. So that's something to look into. If we don't have the luxury of having an outside investment account, what do we do? So if you're a homeowner, another opportunity might be to look at your home equity line of credit, or if you don't have one, then perhaps getting one. Rates are pretty low, so that might be a feasible option. Again, you know, a short-term solution, but this is a time when we need to be looking at all options. And also, depending on the terms of your current mortgage and how long you're planning on staying in your home, etc., a mortgage cash refinance may be another option for you. So bottom line, and what I want to leave you with kind of on this first topic of cash flows is that let's put some thought into what our next, I'll call it your next in-line source of cash will be, right? If you run out of your rainy day fund. Because considering your options and weighing the pros and cons here will not only help you make the smartest decision, but also establishing where you want to go next is going to help you feel more in control. Kind of going back to what I talked about at the beginning, making sure that we feel empowered, making sure that we know what we're going to do next if this first thing is not available anymore. So let's line that up and let's know what it is that's going to help us sleep better at night. Carrie, could you move to the next slide, please? Well, I'm going to go ahead and continue while Carrie's doing that. So revisiting our debt. I touched on debt a little bit earlier, but I think it deserves kind of its own category. And the good news relative to the debt side of the equation is that interest rates are low. We're in a really low interest rate environment. So this makes it an opportunity to refinance any high interest loans, including your mortgage that I was speaking about. And the other thing to put on your radar, and well, hopefully it has been on your radar for a while because the deadline is coming up at the end of December, but the mortgage forbearance program that is available through the CARES Act. So that's likely the one time and one time only in our lives when we will have the opportunity to push the pause button on paying our mortgage with virtually no ramifications. So to the extent that you qualify, this is a really good opportunity to be able to help with your cash flows. And then finally, one word of advice relative to debt. if you find yourself in really dire straits and unable to make payments on your loans, do not just stop paying. Do not just stop paying. Speak with your lender, see if they can work with you during your hardship. And your lender doesn't want you to go into default either. That's not in their interest. So the best strategy really is to communicate with them, reach out proactively, be on top of that, and come up with a plan, because defaulting is not a good plan. Okay, let's move to slide 3 or topic 3. And this is probably the most important slide of this deck. And if you have a spouse, if you or your spouse have lost a job during COVID, I would like to encourage you, because this sort of goes under the radar for a lot of people, but look at all the benefits that you might have lost along with it. And in many cases, this includes life insurance. Do not be underinsured, especially during a time of pandemic. This is really important. So look for a private policy if you lost your life insurance or your spouse's life insurance through a job loss. And there is a lot of change going on in the insurance world right now, in the insurance industry. All of the insurance providers are trying to figure out what this means for their actuarial tables. And, you know, honestly, what I find is most people are underinsured to begin with. So I think this is a great opportunity and a really good time to make sure that we get that needed coverage, because it is likely to get more expensive. It might even get unavailable depending on your specific situation. And certainly an important time to have life insurance in place to protect your family during an event like a worldwide pandemic. Another part of the risk equation here is estate planning documents. A lot of people don't like to think about this. I mean, right? Who likes to face those kinds of topics? But it is important. And, you know, the other thing I hear from my clients is, because I have some more downtime now, I'm finding that I'm able to do these things that I have been putting off for a long time. And that includes estate planning documents in a lot of cases. So by this, I mean wills. If you have trusts, then reviewing those, or if you don't, consider whether you should have one. Powers of attorney and advance directives. And the questions to ask is, are the stipulations that I put in still appropriate? Are the individuals that I named still alive? Am I still close enough to them? Do I have a good relationship with them still? And also the beneficiaries that I put on things like my retirement plan, things like my life insurance, are those still the right ones? And here I want to pause and make a really important distinction. Some people will know this, but I think some people don't, in my experience, and this is important to remember. Even if you have a will in place, your beneficiary designations on things like your IRA, your 401k, your life insurance, those designations take precedence over what your will says. So just updating your will is not enough, because the asset will pass based on what your beneficiary designation is. So make sure that you update those while you're doing all of this housekeeping work. And then just a quick comment on accounts like savings or checking. You want to put in something called a TOD, transfer on death, or POD, payable on death. And it's sort of like a beneficiary designation for those types of accounts. And let's switch to the healthcare piece of it's actually still the previous slide, Carrie, sorry, but I just talking about the estate planning documents kind of more on the healthcare side. So things like your advanced directive, the DNR, DNI, do not resuscitate, do not intubate. I don't think I need to tell you how important that is to have on file right now. And frankly, what I find is that some people's thinking, especially around do not intubate, has changed. So think about this. Severe cases of COVID end up on a ventilator, and that is considered artificial life support. So if your advanced directive says something along the lines of do not use artificial life support, maybe this is a time to revisit that. And maybe it's a time to make that change sooner rather than later. So I apologize for the morbidity of those topics, but I really do feel those are important to be addressing, especially during a time like this. Now, let's move on to more uplifting topics. So the next recommendation, number 4 of my strategies here, is to consider a Roth conversion. And I put this more in the category of opportunity. So it will not apply to everyone, but again, if we're going to be looking at our situation through the lens of how can I take advantage of what's going on to my benefit, this is something that some people may want to consider. And before I get into the details of this and why I'm recommending it, let me just level set. So I apologize to those of you for whom this is basic, but I want to make sure we're all on the same page. So let me talk about what a Roth conversion is and the difference between a traditional and a Roth. So with a Roth conversion, you're converting a traditional IRA into a Roth IRA. A traditional is one where you put the money into it tax deferred. So it's pre-tax money that's in there. It grows tax deferred. And then when you take it out in retirement, you pay taxes from $1 on all of those distributions at ordinary income tax rates, which are the higher tax rates. So as an example, just to make the math easy, let's say you have $100 or $100,000 in your traditional IRA. And let's say you're in the 22% tax bracket. So this means once you start taking the money out and the taxes are paid, you're ending up with $78,000. Now let's look at a Roth. Conversely to the traditional, a Roth starts with after-tax money. So you've already paid the tax on what you earned and then you put it into the Roth. But the huge benefit of a Roth is it continues to grow completely tax-free. And when you take it out, you don't have to pay any tax on it. So clearly there are some significant benefits to having it in a Roth. So if we use that same example of the 100,000 and a 22% tax bracket, well, even after taxes, you're still ending up with $100,000. So generally, based on this, you're probably gathering that a Roth makes sense if you're in a lower tax bracket now than you would be when you're taking those funds out. And the reason that being able to switch from the traditional to a Roth now is there's a couple reasons I bring this up. One is a lot of people, because of their decrease in income, find themselves in a lower tax bracket this year. So this means any money you would pay on the conversion to the government in terms of taxes, because you have to pay that tax before you can put it into the Roth. So those taxes would be taken out at a lower bracket. So it might make sense. The second reason is the Secure Act last year got away with something that was called a stretch IRA. And so if any of the money that you have in your retirement accounts, you're planning or you're hoping will be passed on to the next generation, it's going to be a lot more efficient vehicle for you to have it in a in a Roth versus a traditional IRA. So I realize this is not a strategy that everybody's going to be able to do this year. You will need to have enough cash to pay for the tax. But if your tax bracket is significantly lower, it might be a good year to consider that. All right, let's talk about your portfolio next. So often we continue putting money into our retirement savings, and we probably never ran a projection as to, are we saving enough? Are we putting in enough? What are we on track? So if you've never done this, you need to do that. And if you've done it, this is a really important time to redo it. And why do I say that? So first, some people had to decrease their contributions to their retirement accounts because of job impacts and things like that. So if you're in that boat, then you probably want to see what impact that has on your long-term retirement outlook. Second, the recent legislation through the Secure Act changed what's called the required minimum distribution age, which is when you have to start taking money out of your retirement account so the government would get their tax. So that changed from 70.5 to 72. So this also has an impact on sort of what your retirement distributions will look like. And so it's important to incorporate into that picture as you're looking at it for the longer term. But third, and probably most important, turbulent times like what we have seen in the market are a really important time for us to be reassessing our risk tolerance. So I am thinking maybe some of you have filled out one of those risk tolerance questionnaires, whether if you have an advisor, probably in the advisor's office, or maybe if you don't have one, you filled it out online. And it sort of shows you, here's what your appetite is for risk. And what happens in times like what we saw earlier this year, and frankly continue to see to a degree in terms of the ongoing volatility, is people realize that their risk tolerance really is not what they thought. So there's a world of difference between, filling out that questionnaire online in the comfort of your home or in your advisor's office and kind of trying to figure out what that might feel like if there's a huge dip in the market, versus then actually experiencing it and looking at your 401k statements after that 30% drop that we had earlier this year. And what I find is that a lot of people decided that they need to be more conservative in their allocations because that type of volatility was just too much for them to bear. And it's difficult for them to sleep well at night with taking on that level of risk in their portfolio. So it's kind of beyond the scope of what we can do here today to get into details, but what I want to leave you with is that this is a good exercise to go through and make sure that your allocations in your retirement accounts are still the right ones based on everything that's going on. But only change your investment mix if it's warranted from a long-term standpoint. So I would really want to dissuade you from any kind of a knee-jerk reaction because of the market volatility or because of a temporary hardship. So let's look at this, but let's look at it from the long-term standpoint and keep the long-term in mind. So that's my 5 strategies, but I have a few more tips for what I would call special circumstances. And I'll kind of breeze through this quickly because I don't think it will necessarily relate to a lot of people, but for those of you who fall into these categories, hopefully these are tips that will allow you to save some money. So I just want to quickly put it on your radar. One is if you have lost your job and you own your company's stock in your retirement plan. So let me explain that. Say you work for company X and then you own stock of company X in your 401k or your ESOP plan. And if you are in that boat, do not just roll your 401k into an IRA before looking into something called NUA, or net unrealized appreciation. And again, it's kind of beyond the scope to get into details, but it can save you a lot of money because you might be able to take, instead of taking ordinary income tax, you might be able to take capital gains tax on that particular stock. So something to work with an advisor on and make sure that you take advantage of that if that's your situation. Second piece that is, I think, helpful to consider during this time is what's called QHFD, or Qualified HSA Funding Distribution. And this is relevant if you have a health savings account. So again, not everybody will have that. And so if you have an HSA and you can't fund it this year, this might be something to consider. It's a strategy that is actually only allowed once in your lifetime. And so there's not a lot of those, but given the kind of year that we've been having, this might be the year that you want to do that. And two things will determine that. You know, one thing is if you have an HSA and you are not able to fund it through your cash flows, and then two, if you have medical expenses this year that you want to be able to funnel through that HSA. And what you can do under this strategy is take money out of your IRA and put it into the HSA. And not only you don't have to pay penalties or taxes, if you use that money for a health situation, a healthcare expense, you actually don't have to pay any tax on it at all. So I just wanted to put that out there for those of you who might be in that particular circumstance. And then last but not least, if you are getting close to age 62, which is when you first qualify for Social Security, you should work with your advisor to reassess when is the best time to start taking Social Security. Because you can start anytime between 62 and 70, and the longer you wait, the higher the benefit that you're locking in for the rest of your life. So there's certain formulas at play here, and the reason it's important for you to be looking at it now is if your situation has changed relative to a lowered income that was unexpected, or a change in your expected retirement date because of COVID. So those things would play into what that formula looks like for you and when is the best time to start taking Social Security. So that right there brings me to the end of the list of my strategies and tips. I just want to summarize, if you want to go to the next page, Carrie, I just want to summarize quickly what they are again. So addressing cash flows, revisiting your debt, protecting against risk, which is so important right now. Considering a Roth conversion, if that's in the cards for you, might be a nice opportunity this year. And then taking another look at your portfolio to see if it needs to be reallocated. And as I said at the beginning, I really encourage all of us to look at this current situation as an opportunity to sort of readjust and refine our financial plan, given everything that's going on. And clearly, finances might have seemed daunting this year and up to this point. But what I'm hoping that I can inspire you to do here is take control of the things that you can take control of. There's so much out there right now that is out of our control. And so feeling like you can take some of these steps right now, you can make your situation a little bit better, and you can start to feel like you're in charge of your finances again, that will go a long way. And it feels really good to be able to put your financial house in order again. So let me just end with that quote that you saw on my earlier slide, which is, in the midst of difficulty lies opportunity. And that's Albert Einstein, very wise words. So I really hope that all of us can remain hopeful, even through all the dark times that we have seen in 2020. So it was a real pleasure, and that's the end of my prepared comments, and I know that we wanted to leave some time for a Q&A. So I'm going to turn it to Bridget right now to help us see if there are any questions.
Well, thank you, Zuzana. You gave us a lot of great things to think about. We've had one question in the chat, which I sort of took the liberty of answering myself. And so, I don't know, maybe wait a moment or two if there's anyone that has any more questions. But if not, well, we can kind of pause for a minute. By the way, I love the slides. I love your staycation pictures. Those.
Thank you. It was fun putting that together, because you know, it's a good reminder to stay positive in the dark times. It's not been easy for any of us, that's for sure.
All right. Well. All right. Well, why don't I turn it over to Rachel? I'm not seeing any more questions come in. We'll do our best to answer them if they do.
Okay. And so a couple things for me, if I may. One is, you guys have my contact information here. If other questions pop up, I'm happy to make myself available, so reach out. The other thing is, we do have to advance to my very last slide, because that's compliance. And my compliance department would not like that if I did not show that as part of the presentation. So thank you for that.
There.
Okay.
You've done your due diligence.
Yes, I did.
Oh, actually, wait, we have one. Before we let you go, what is the target amount to have in your retirement account when retiring?
Well, I wish I had a number that I could just throw out, and it would be a number that sticks for everyone. You know, there's that kind of rule of thumb of you should have enough to cover 80% of your expenses, right? So in other words, to be able to cover 80% of what you were spending while you were working. Frankly, I find a lot of times people are spending the same, if not more, in retirement. So I'm not sure that isn't a great guide. Another rule of thumb is the 4%, the 4% rule. So kind of having enough so that you can continue to draw 4% over time, adjusted for inflation. You know, I've worked with hundreds of people on their financial planning, and no two financial plans are the same. So I can't tell you it's $500,000. I can't tell you it's, you know, any magic number. It really depends on kind of what your situation is, what your assets are, what your income streams are. But one thing I will, you know, give you just kind of general guidance on, because this is how I look at retirement planning when I do it with my clients, is you start with what your goals are, and a good place for that is starting with your current budget, right? So then see if you can make any adjustments to that relative to how is retirement going to be different. You know, maybe you're going to be living in a different home, or, you know, whether you downsize or upsize or what have you. There will be changes to your health expenses. There will be, you know, changes to other things. So start with the budget, then move to your income streams. What are you going to have available in terms of income in your retirement? So for most people, that will be Social Security. If you don't know what that looks like, go to the Social Security website, which is ssa.gov/myaccount, ssa.gov/myaccount, and you will able to pull up your actual statement. So work off of that. If you have any other income streams, like, you know, some lucky people still have defined benefit pensions out there, which is great. Some people might have, you know, part-time job, or maybe you own rental property, so you will be able to collect rent. So whatever your incomes are, then look at that next. And then the third piece is, what do you have saved in your assets in terms of your retirement accounts or any other accounts that's available for retirement? So when you look at that shortfall between your goals versus your incomes, that shortfall needs to come out of those assets. And there's, you know, a way to be able to apply that, but again, beyond the scope of this conversation today. But, you know, if anybody has more questions, I'm happy to make myself available after the fact. So I hope that's helpful.
Thank you. So I think we're out of time. Well, why don't I turn it over to you to close us out?
Okay, sounds good. So I hope everyone gained some little tidbits there that were helpful. I know I got a couple myself, just reminders of, oh yeah, I need to go, it's probably time to go look at this or that. But a huge thanks to Zuzana, you know, for all of the work that she did to you know, and the willingness to come in here and chat with all of us. So that was great. And also to Carrie Kelly, who shows on here as Cindy Elkan, but the one working behind the scenes, and really, you know, was able to take the idea that we had for this session and make it a reality with the resources that she's got from the United Way. So she and her team did a great job, and we're able to bring all of you guys here. We are interested in getting some instant feedback, so to speak, from you all on the session. And so Carrie, would you mind just popping the link to the survey in the chat window? It's 3 questions, and should just be, you know, take a minute of your time, but it would help us, you know, look to the future as we try to figure out what we as a United, Women United team do in the future, especially in this COVID world, where some of the things that we normally would be doing to raise awareness, raise funds, etc., aren't possible. And so let's see, I don't see, so hopefully, Carrie, you were able to, if you didn't hear me, if you could post the link to the survey, or Jed, if you have it handy, somebody just pop it in there so we can get people before they leave. And then the other thing, I know Jet had mentioned the $600+ that we were able to raise through, you know, all the people registering for this and clicking the donate button. Really appreciate that. It's going to help us bring some joy, little extra joy to some of the struggling women and families in our, you know, Tri-County area. And I'll ask Carrie again to post a link there, and just in case it got lost from, I think maybe she posted something at the beginning of the session. But anyway, if we could just get those couple of links in there and try to get everybody before they drop off, that would be awesome. Let's see, I don't see them.
Yeah, I don't see them either. And so it may be, just be on the lookout for a follow-up email with some, you know, some of the resources and some of the links. I don't know if,
they should be there. I see them. I see all the questions. Yeah, I posted the survey link is the Survey Monkey link, obviously, and then the donate link is the classe.org link.
Yeah, we don't see it. Maybe did you send it like to not, like, did you have that to everyone?
No, let me copy these again and do that.
oh.
Sorry.
Probably don't have to screen share anymore either.
There we got the classy one. And so, yeah, if we could just get the Survey Monkey, that would be awesome.
Right. Here we go.
Thanks, Carrie.
There you guys go.
Awesome. Thank you again, everybody. And hope you all have a great Thanksgiving and end of year celebrating however you will be celebrating given our current situation. So yeah, with that, thanks everyone.
Thank you all.
Thank you.
Thank you. I posted the holiday party information, by the way.
Hi, can I ask a question?
Sure.
Will there be any meeting that will cover choices like annuity or drawing retirement income another way without setting up an annuity?
I think that is, I want to make sure I'm not muted. That's a very sort of specific question. I don't, that might be tough to, let me talk to Zuzana about that. But I think in the meantime, if you want to reach out to her directly, she can help. I'm trying to envision what a seminar of that nature looks like, because I feel like it's a pretty narrow scope. And I'm sure Zuzana would be happy to help you.
Yeah, I've done seminars that are specifically geared towards retirement planning. So you know, depending on, and I don't know, you know, what the audience is or what the needs are. So we can talk about that just to make it relevant. But yeah, let me know. And I also just want to say thank you so much for allowing me to be a part of this. I feel like this group has such awesome energy and such a great cause, and the fact that everybody was so generous to be able to fundraise this much money, that I'm just so honored to be a part of this. So I really appreciate all of you.
Great. When,
can you just tell me how you would go about reaching out to Zuzana directly?
Yeah, if you move one slide up, my contact information is there.
I think she's on the
I'm
phone.
on the call by phone. I'm not on the call with the imagery.
Oh, okay. Well, let me just give you my phone number. It's 802-881-6732.
Thank you so much.
And my email is just zuzana.brochu@peoples.com. So that's pretty easy too.
Okay, thank you very much.
Sure.
I enjoyed listening to the whole seminar. Thank you.
And we ask you if you can put your thoughts in the Survey Monkey on things that you'd like to see in the future. And if we get, you know, sort of around the same themes, we'd certainly try to create some content. So.
Thank you.
Yeah, thank you. All right.
Bye-bye.
Bye.
Bye all.
Bye.
Nice job, ladies.
Thank you, everybody.
Thanks, Zuzana.
Bye-bye.